It's something most of us have, but we don't know a lot about, and that is a credit score and how it plays an important role if you are looking to make a large purchase, like buying a house or buying a car. Financial expert Robyn Thompson is here to break things down, separate the fact from the fiction for us. Good to have you here.
It's nice to see you again.
I was saying this is one of those topics that if people feel they should know more about, but because they don't, then they don't ask because they feel like they should know. But you're going to set this record straight for us. First of all, how are credit scores calculated?
A credit score is a 3-digit number that's taken from information within your credit report. So in your credit report, you have a bunch of different items that either assess whether you are strong in credit or you are not so great with credit. So strong would be things that you're doing or actions that you're taking that show you are credit worthy, and actions that show you're not credit worthy would sort of bring down that score. So a bunch of different information to take a look at, but it's really about, are you being responsible with credit?
We're going to show you how to do that, but first of all, it's a bit of a financial report card, really. So let's show you what that looks like. Here's the different categories of a credit score. So 760 to 900, amazing. And at the lower end of that, you've got 300 to 560, poor credit. If you're someone who has a lower score, what effect does that have?
Well, as you can see, it's a pretty large scale. So if you're in the bottom part of that, especially the 300, the bottom two categories, you're going to have a hard time getting credit from different financial institutions. So these would be things like credit cards or loans, mortgages, lines of credit. It'll be very difficult to assume any credit. In the middle category, you're going to see a bit more leniency because you've established some good credit. You'll have better rates, but really where you want to be is the top category, which is excellent credit, which means you'll have a variety of different lenders willing to lend you credit, different types of credit, and likely at the best interest rate.
One of those factors, Robyn, if we can put that board up again, is the fact that you can carry debt. But a lot of people with a mortgage, is that considered debt? Does that keep you in that 660, 724 average range?
Yeah, so when you look at debt and credit, you want to make sure that you're playing by the rules when it comes to your credit report. So the number one factor that impacts your credit is making your payments on time. So whether it be a mortgage or a credit card or a line of credit, make sure you're making your monthly payments on a regular basis. That will keep you in the middle. If you want to go into the higher scores, you need to do things like diversify your credit, take on different types of credit. Make sure that you're also checking your credit reports. We've seen some news out this morning that there's been some compromise of Canadians' information, up to 6 million Canadians. You need to look at your credits report on an annual basis and go through to make sure that, number one, you are making those payments on time so your credit score is going to rise, and that there hasn't been any attempted fraudulent activity on your behalf, that you have in fact applied for all those mortgages, all of those credit cards or lines of credit that you may have, because you won't know if you don't go into your credit card and take a look at it. And as you can see from this morning, it could have a huge impact.
Somebody described it to me this way once, as a financial physical. Just like you would go and get a physical every year, you got to check your finances every year. A lot of myths associated with credit scores, a lot of fear around that. You're going to break down some of those for us. Your score drops if you check your own credit. Is that true?
It's absolutely false. It's considered a soft inquiry. So like I mentioned a minute ago, you'll want to check your credit score. The only time that an inquiry hurts against your credit score is if it's from a lender looking for potential credit. Your own score does not.
Okay. Closing old accounts raises your score.
That's absolutely false. The longer the credit established that you have within your credit report and the longer that you're showing good payments and on-time payments, the higher your credit will become. So the lower and the shorter amount of credit that's been open will actually hurt you, whereas the longer credit duration, as long as it's in good standing, will help you.
All right, paying off a negative record takes it off your credit report. You got rid of the debt, and so now it's coming off your credit report.
Not for up to 7 years. So up to 7 years. Delinquency payments, bankruptcies, anything that's in your credit report can stay up to 7 years. It will have an impact until it's purged after the 7-year mark.
And I don't know how this one got started, but it is out there. Paying off a debt boosts your credit score by 50 points.
No, that's definitely not true. So, I mean, you can pay off, obviously you'd want to pay off your debt and lower your debt, but there's so many factors in creating a credit score and complexities that not one specific factor is going to be able to do that. So you need to make sure that overall, lower your debt, pay your debts on time, and make sure that you're practicing good financial management. At the end of the day, it is your financial checkup and report card, so you want to make sure you're doing the right things.
This is such good information to have. Thanks for coming back to share it with us.
Nice to see you anytime.
Thanks for watching. If you like this, be sure to subscribe here.
And you can check out more Your Morning videos right here.